Hi, this is Joe Bartlett, and welcome to the CEO Unplugged podcast. I'm here with Mr. Sang H. Lee of VegaX. Sang, welcome. Can you tell me a little bit more about your background and how you made the transition from a traditional finance company, a finance position at a big institution, to opening your own digital asset company?
Hey, Joe, glad to be here. Yeah, I'm happy to share, about my background. So I spent a number of years, as you mentioned, working at, one of the mega banks, in New York. Interestingly enough, I started my career at the height of the financial crisis. And so it was a very interesting time for kind of a fresh mind out of college to basically take in everything, right? So we were across the street when Lehman imploded, so kind of standing around during lunchtime, seeing what's going on over there. And obviously that also meant that a lot of the business that these financial institutions were doing at the time wasn't really new and exciting business, but it was really trying to kind of fix what needed to be fixed. And taking care of a lot of the portfolios that were already in existence. And through that process, I was kind of firsthand able to see the inefficiencies not only in organizations but at the industry at large, right? So when we think about financial services as a whole, as a global entity, obviously it's one of the largest in the United States, but it is a global industry. And yet, a lot of the things that we were doing were very, very inefficient. They were subject to, time zone issues. Obviously, a lot of it was manual paperwork, and so that really was the catalyst behind my ideas around how to use technology or anything kind of digital, going from analog to digital, in order to make the industry more efficient as well as more accessible by every kind of investor.
Oh, so what's the best part about starting your own company, and conversely, the worst part?
I think the best part of starting your own company is that you're able to build something that hasn't been done before, right? So it's not just about having the greatest idea. It's not just about having a passion for something, or trying to be more ingenious than the next kind of business idea. It's a combination of all of that, right? So when we think about what we wanted to build at VegaX, you think about what the future could be, right? And I think being a part of that journey, and obviously as an industry participant, not just in making widgets but also driving ideas forward, I think that is very, very exciting. I think I wouldn't say it's the worst part. I don't think there's a worst part of starting your own business. I think there are difficult parts, right? So I think the most difficult part about starting your own company is the same thing that makes it the best thing ever, right? And it's the fact that there are a lot of unknowns, right? And so by definition, a startup or entrepreneurship has to be largely unknown. Otherwise, it's not really entrepreneurship or a startup, right? If there's a lot of knowns, that means it's either a business that you're replicating in a different area. But even if it's in a different area, there's a lot of unknowns there, right? So I think that is the most difficult part, is that there's no playbook for it. Obviously, even the industry doesn't even have a playbook because you're trying to develop a new industry. And I think that's probably the most difficult and exciting thing about starting your own company.
What inspires you each day to put in the hard work and to do the grind that it takes to thrive in this kind of a startup environment in the world of digital assets?
I think it's a combination of obviously a passion for the industry, but I think it's also my colleagues and my co-founder. Being with the most exciting and smartest minds to be able to build something as difficult and as exciting as a digital asset industry. It's not for the faint-hearted, right? Like it's something that we're changing in $100 trillion industry. It's heavily regulated, but this new technology, digital assets, blockchain, et cetera, is nothing like we've ever seen before. And so that means we have to learn new technologies, we have to learn about new economies, we have to learn about how to make these things integrate with the existing industry and trying to make that transition as smooth as possible, which is what we're looking to accomplish at VegaX. I think those things are what really inspires me to put it on every day, right? Along with my co-founder, along with my team members, my globally distributed team members, we're working 24 hours a day to try to get the next increment closer to our end vision. And that really is a big part of the driver that makes me really excited to get up every morning and probably not sleep the night before either. So.
I bet. Well, look, digital assets and cryptocurrencies tend to be pretty volatile assets. How can investors protect themselves and their portfolio from that kind of volatility?
That's a great question. So, as with everything that's new, it does tend to be a bit more volatile. So when we think about venture capital or startup investments, they're very, very similar. However, we don't see that volatility because those assets are what we call illiquid, right? So you can't buy and sell them on an open market. So there's no market consensus on what the price is beyond when there's a valuation event and a group of investors decide to invest into the XYZ company for $100 million, there is a de facto price of $100 million. But in reality, you can't trade that for $100 million, right? And so, the digital assets and cryptocurrencies are a little bit different, even though it is still a nascent technology, in that it started off with an open market. Right. So day one, it kind of started off with an open market. It went directly to investors versus going through institutions, which is a lot of the benefit that digital assets and cryptocurrencies face. But I think investors can be best protected if they're the best informed. Right. And this is going beyond, tips on how to do best investments or putting your portfolio together, because even if you don't think about cryptocurrencies or digital assets, even if we think about like traditional assets, for the lay investor, it's not going to be the best advice to say, or here's this complex portfolio diversification strategy that you should undertake, and here's the stock, and then you're going to lock it up and put it in the safe in your house. Right. Like none of that is what happens right now. And yet that's how we tend to talk about things in digital assets, right? So when we talk to, when you talk to a lay investor, it's what is the objective of this investment? Right? Like, what is the goal of this investment in the long term? Why should you buy digital assets? Why are cryptocurrencies important right now? And understanding that at a macro level, I think becomes the best protection for investors. And what I mean by that is, obviously we have a somewhat of a biased view, right? Some biased lens on, what the industry holds for us. But we do believe that this is probably the biggest change that we've seen in the last 100 years. And not including these types of assets in your portfolio can be dangerous, like as the inverse, right? Wow. Even though the prices are volatile, that's like saying, well, that looks dangerous, so I'm not going to touch the thing that is going to drive economies and countries in the next decade, right? And everything else that I'm investing in right now might become victimized by that change. And yet I want 100% in the traditional, I don't want it in the new. That could be quite dangerous, right? So even a small, 1 to 5% kind of portfolio diversification can, I think, be the best protection, because to be frank, there will be continued volatility going forward. And obviously some of our strategies on our indexes are designed for long-term growth, are designed for some partial hedging, but beyond the specific strategies and what you can do in this asset class, in reality, the investors are best suited to protect themselves when they are involved, right? So when I have an idea of what Bitcoin or Ethereum is, I am the best protected. When I have an idea of why decentralization and blockchain technology is going to change the way we think about business and institutions, I am better protected. I'm not better protected because I have millions of dollars of Bitcoin, although in the future that may play out very well. On the average, the best protection is getting involved, right? That I think is very, very important. And the easiest way, quite frankly, to get involved is to buy something. Yeah. Right, and try it for yourself. That's where you find the most interest. Just reading about it is not quite enough. And there are things in digital assets that we have never done before in traditional finance, right? Like addresses and wallets and sending it from one place to another without the help of an intermediary or customer service can be quite scary, right? And so these kind of things are baby steps, but I think that in and of it itself, involvement and execution tend to be the best protection for investors.
Good said. Good, well said. Saying much has been said this year about the crypto industry's tacit reliance on global liquidity. A competing narrative is that as sovereign debt markets continue to break, investors will be looking to enter into decentralized stores of values, precious metals, commodities, and certain crypto assets. Can you give us your bear and your bull case for the crypto industry moving forward?
So I think that a lot of that narrative that exists around global liquidity, around institutions trading crypto, is quite factual. I think institutions are already, pretty deep in the journey on involving either on offering some type of cryptocurrency product to their clients, if not investing for themselves. So I think that's really, really important. However, as with any asset class, liquidity is important, right? And actually, 2008 is probably an interesting time to kind of reference when we think about global liquidity, in that stocks and bonds are supposed to be inversely correlated. That's why you did 60-40, the past several decades, which we understand now it doesn't really work that well from a risk perspective. But anyway, in 2008, everything went to one. We say it went to one, right? So correlation went to one, and which means when something went down, everything went down together, right? And so when there are tacit restrictions or kind of globally permeated fear in the markets, it only makes sense that everything correlates with each other. That's just logical, right? What we're trying to look at or understand here is what is the impact of sovereign debt markets kind of unraveling, right? We're looking at the Japanese yen as one of the big incidents that are coming up. We saw it with the British pound, right? With the Bank of England kind of in a very weird situation where their equity was not worth as much as how much they had outstanding. The United States also printed about 80% of all M2 in history over the last COVID years, right? And so when we think about these things, the original narrative of crypto assets comes about. And that's what I think all of this is about, right? Which is, if you go back to the original premises of why decentralization or why Bitcoin, et cetera, it's that you can't print more. Like that was the easiest kind of narrative just around Bitcoin. Obviously, there are other assets that have different rule sets of economic governance, but let's just stick to that one for now, which is you can't print more, and no one can decide to print more, like by themselves, right? And so that narrative is playing out in the debt market, right? The debt markets are you borrow too much or you printed too much money, and that's putting pressure on the system. And so I don't want to buy fiat currency anymore. I want to buy other things that have an inherent built-in scarcity, precious metals, commodities, and certain crypto assets. The thing is, the precious metals and the commodities can work as stores of value, but they don't work as an economic system. And what I mean by that is, if I bought gold and the currency continues to kind of destabilize and become more volatile, I don't have a better way to use my money. I'm just holding gold, right? It's a physical good. Right. I can't go to the store with gold. And which is why the efficiency of a store of value is one of the questions that are coming to bear, right? So when we think about Bitcoin, for example, it is based on proof of work, right? And proof of work is very, very secure. That's why we talk about mining, the hash rates, et cetera. But what it also does is it makes it pretty inefficient as a blockchain, because it has to be very difficult to crack, right? So the more secure it becomes, the less efficient it becomes. So gold bullion is probably pretty secure because you can't really run away with a lot of it. Yeah. However, you can't really use it. Like, you physically cannot use it. And so when we think about, oh, why is this one better than that one? Okay, this has scarcity, but I can't really use it. You automatically get to the point where you say, well, crypto assets are scarce. there is a finite supply that is proven by math and by electricity and production, and I can send it around to different places without any restriction. And those are the things that I think are coming to fruition right now to like a lot of the mainstream, right? Which is Bitcoin was a very hot up and down, Ethereum, et cetera, up and down. Beyond that, people are saying, well, what is the real tacit use case for me for crypto, right? And that is a bull case. That is the mega bull case, which is that money is better than that money, right? It's not the complexity of Bitcoin or gold. It's not that. It's the next generation, including, you know, the folks that are using it now, saying, I don't really like this money. I like this money better. And, you know, what people also underestimate is that the next generation, you know, younger than us, the MZs, you know, folks that are maybe in like junior high or high school, they will never use fiat currency going forward.
That's
so
amazing.
Like they've already said, you know, if you ask a lot of, you know, we were talking about a friend's son, you know, gave him $100. He didn't want it. He gave it back. He said, I don't want this. Send me some of the internet money. Right? I don't even know where I'm going to use this. Like, give me the internet money, right? And so, like, you know, when you think about that, there's really no going back. It's just that we're not dealing with it day to day. It's the transition has already occurred. It's just that it's taking time for the adoption. So, bull case is that the mediums by which we are building this industry are used as the mega rails, right? Payments, store of value, investments, et cetera. That's a big, big bull case. A bear case, just to put this into positioning, is ironically the similar situation. And what I mean by that is the bear case is caused by the fact that there is a mass exodus into the digital, right? And so in order for it to be a bull, there has to be a bear where something is starting to unravel at the seams.
That's right. Yeah.
Right. And we're kind of seeing a little bit of it, but there is a situation where that could be orderly, but finance tends not to be that orderly, right? It's first one to the door, right? And so because it's not that orderly, what we're going to see, I think, is that the bull cases will be driven by these periods of bear environments, right? And so something bad happening at the global economic level, which then says, oh, that's why I was supposed to buy Bitcoin, right? And then you see that market going up, and then we're going to see it cyclically happening over and over again, and think until you know, it touches pretty much every aspect of our lives.
Well, a lot of people are cautious about getting into cryptocurrency, as you just stated there, whether they just don't understand it, or is it they feel it's too unpredictable. What's your advice to someone who's looking to get started?
Yeah, so I think what's really important is just to buy it. Like I really don't have like very, very profound advice, because it's like you can recommend books, you can recommend, you know, a lot of reading. That's not going to help somebody understand, to be honest. So a little bit of purchasing, I think that's really, really important. If you don't want to purchase it, ask for a gift from a friend that has it, right? Because then I'm forced to that's what I did actually with a lot of my friends as well in the early days, which was, if you can make a wallet and send it to me, the address, I will put $50 into your wallet.
Oh, cool.
Right.
All right.
And so like everybody who's never done any crypto said, what is he talking about? And I said, it can't be an exchange wallet. You have to make your own wallet, right? So like it can't be a Coinbase wallet or something like that. It has to be your own wallet that you made separately. And then I will, you know, then you understand custody, you understand wallets. So I will send you $50. And, you know, some of my friends never got there, and because I only gave them 24 hours. But, you know, that I think, you know, opened up a lot of eyes, right? Around, oh, this is a lot more difficult than I thought it was, or this is a lot easier than I thought it was. This is pretty amazing. But it becomes relevant, right? So whether or not it's volatile, whether or not it's going to be a big part of your portfolio, whether or not you've been, read into the Web3 thesis, it's not important, right? What's important is that you've touched the blockchain, and you start feeling the power of that technology.
I think you're going to be touching the future too, right?
Yeah, that's right. That's right.
Sang, tell us how people can learn more about VegaX.
Oh yeah, absolutely. So you can visit our platform, vegaxholdings.com. We have several indexes and strategies. We also have a great research center where our team is able to produce a lot of different insights into the market, right? Especially for new folks that are coming in. At VegaX, what we pride ourselves on is the ability to synthesize, very difficult technological ideas, but make it very easily digestible, right, into the strategy. So I don't have to go through the headache of doing all these things ourselves, which we've already done, for better or for worse. We've done that in financial services, right? Like I don't wake up and worry about how my 401k is rebalancing, or like, if I have to buy and sell it at 7:59 UTC time. Like I don't have to do those things because there's infrastructure to do that, but that doesn't really exist in digital assets yet, right? So that's the bridge that we're trying to provide. So visit us at vegaxholdings.com. On our site, you can also follow us on Twitter. We're very active on there, and LinkedIn as well.
Excellent conversation, very informative. It's a pleasure talking to you, Sang. Thank you very much for coming in today. This was the CEO Unplugged podcast. I'm Joe Bartlett, and our guest today, Mr. Sang H. Lee of VegaX. Thanks again, Sang.
Okay, thank you. Thanks, Joe.